As you may have heard, there was a Fed decision today. It's a one with a presser, so to speak. And a lot of people don't realize, but this is a very important one because this is the end of the first quarter, and we have one of the most important, I guess, options expirations coming up this Friday for the first quarter. That's the second largest one next to December. A lot of people don't realize that, but it's a pretty big one. I was taking a look at the open interest. I really actually wish I had the benefit of seeing the OI for tomorrow now. They don't update the numbers, but there was a lot of movement today. There's a lot of volume, and I suspect there'll be some pinning action going into the next couple of days. Anyway, let me discuss for you the Fed. I just took some notes on the Fed, my chicken scratch here. I was trying to write this was actually kind of hilarious. What I should start doing on Fed decision days, the ones with the press conferences, is hire an assistant to come over here, write down the notes. Like she'll say something, yell in, I'll say write that down, and then I could trade. So I was like writing and trading and tweeting. I mean, this was like almost like a Three Stooges episode here today, of trying to do a ton of things at once and do them well. It worked out, but it was definitely not so easy. I don't get commercial breaks, so once in a while you'll see me swig some water. All right, so let me get into this this Fed decision here. So, yeah, special assistant. Yeah, it would be nice to have an assistant. Anyway, let me finish. Let me go into this Fed. What Janet Yellen said. I'm going to go over the notes I took. I put some stars next to them, and then I'm going to give you my take on what was said today. So, she started off by saying that not much had changed since their December read. The labor market had some improvement. There was some improvement in the inflation. I guess she's really probably referring to energy there. She still says global risks. That seemed to be really a very key focus in the Fed this go round, was their fear of global contagion. And we'll circle back to that in a little bit. She mentioned that there was a little less part-timing in the labor force, which I guess is good. I think that's a recognition by the maybe I'll give my commentary line by line here. I think that's a little bit of a recognition by the Fed that the job quality has been rather poor, and that they've basically been doing, I mean, I've discussed this, that part-timing has been a huge thing because of Obamacare and companies trying to circumvent the Obamacare tax, and they're hiring part-time as opposed to full-time, and they save a fortune. She, of course, noted there's still room for improvement. She said that the wages have room for improvement. I mean, it's funny. They always get excited about like a little uptick in wages. But I'll tell you, I live in New York City, and, you either really sink or you either swim or you sink here. It's really expensive. And, if you get a little bit of an uptick in your wages, you know what? I just realized I forgot to plug in my mic. Is the sound a little bit better there? I realized I forgot to plug in my mic, so that should improve the sound quality here quite a bit. Yeah, I would imagine it's much better. So, yeah, she was saying there's room for improvement there, which is, and I guess room for improvement like there was improvement for the sound quality here. Inflation, so this isn't something I think that the media missed. And she said that the inflation-adjusted income improved, and consumer inflation was up, what do you call it, without when you don't factor in energy. So here's the problem. We don't have inflation. We have deflation. And when they say that inflation-adjusted incomes improved, I think that means that people's buying power really for the same amount, that was a cute way of saying that their buying power for the same amount of money or less has improved, not that their wages improved. So there was a little bit of a sleight of hand there. If you ever played three-card Monte in the subway, there's a group of guys there. They put the ball, then move the nut, or they do it with other cards, or they do the nutshell with the ball underneath. And then when you win, they say the cops are there and they run away and don't pay you anyway. So I think that was what what Janet Yellen was really trying to do here. It was a bit of that sleight of hand. So. So that to me is actually really rather bearish take on the economy. The dollar and energy, of course, she talked about being transitory. And this to me, this is like an amazing, this to me was an amazing admission that they don't see themselves reaching the 2% inflation target for 2 to 3 years. Whoa. That is rather incredible. That means she thinks for the next 2 to 3 years that we're going to have a stall speed economy. So what the hell were these schmucks doing raising interest rates in the first place? So that to me is absolutely a stunning admission that they really aren't seeing very much in terms of economic growth for 2 to 3 years, nonetheless inflation. Here's one of my favorite lines. GDP just a touch lower than consensus. They had a litany of GDP revisions, by the way. For March, it was 2.2%, down 0.2%. For 2016, 2.1%, down 0.1%. And then by 2018, in the long run, they said we're unchanged. But those are going obviously in the wrong direction. Global growth, they said at a softer pace. I love these terminologies. Basically, she was trying to put lipstick on a pig, saying, you know, it's a really crappy economy out there. The world, you know, we are the world, but you know things are bad. But we're going to just say that they're just a little bit bad, as opposed to like, you know, that sort of to me was the equivalent on the Titanic of them playing music to keep people calm as the ship was sinking. Yeah, so that to me was a rather stunning admission. Then she basically talked about the S&P 500 a little bit, stocks, and then she was talking about the spread of high yield over the risk-free rate, which of course is code for HYG, the high yield ETF. So if Janet Yellen had I'm sure she has an iPhone or whatever, the stock ticker she has under the stock app are SPY or SPX and HYG. So we know she has now confirmed that she's looking at that. And of course, they always look at the bond market, so TLT. So those are the three tickers that the Fed is looking at from now on. So she talked about that they want to verify that the reason why they're a little conservative on their rate hikes is they want to verify that the labor market is sustainable, meaning she doesn't really believe the growth. It's sort of probably within their tolerance, meaning it could go up or down a little bit, and it's not showing a trend breakout. It's sort of like consolidating in a range, waiting for the breakout up or down. So that's to me what she was saying by that. And then this was an interesting little tidbit. The neutral Fed funds rate, she said, is historically low. So that to me is code, and I wrote on my tweet, wait for it, code for lower for longer. Whenever you hear them from now on say the neutral Fed funds rate is historically low, will remain historically low, anything with those words means lower for longer. So she doesn't, you know, I guess she doesn't tweet Yellen with hashtags, but what she really should have said was hashtag lower for longer. So this to me was also interesting that they plan on holding their positions, you know, their treasury positions that they loaded up on in QE. Throughout the normalization process, which to me is a little crazy. It's like holding a stock while in a declining tape. And might have to, just in case they have to lower the rate to zero if there's a financial shock. So the Fed is already saying they're either bracing for or ready to do more QE, or, you know, the only way to bring rates to zero is to buy more bonds, and that's QE. I mean, she didn't say QE, but that's to me the way you do it. So yeah, basically, if they need zero interest rate policy, correct. So they're like on a hair trigger here, in my view. By the way, just so you know, when you read the Fed, you have to think of it as if you were a 4-year-old. Of course, you need to be a genius to decipher what they say because they're all this double speak and back talking. But once you finally decipher it, you just pretend you're a 4-year-old and you hear this, and whatever direction that means, that's the right direction. It's as crazy as it sounds, but that is the truth. No college professor will tell you that. No guy on TV will tell you that. I mean, but that is the truth. So that's the story, that they're worried about a shock. Then this to me was absolutely, I think, lost on the intelligentsia of the media. Any 4-year-old would have picked up on this. The 2% objective, but they don't want to overshoot. So this is interesting. They want to get to their 2% inflation objective, but they don't want to overshoot. But then she added in a caveat, a little caveat there, and she started talking about, but it's symmetrical, the symmetry. So if we've been underneath the 2% target for X amount of time, will she now let it go over the 2% target for X amount of time to have that symmetry, that balance out? Yes, the answer is yes. So they are willing to tolerate more than 2% inflation. So let's circle back to what I said earlier, that they're going to take 2 to 3 years to get to their 2% inflation target, but they're willing to tolerate more. So what does that mean? 5 years? I mean, who knows? Who knows with these people? This could go on this could go on forever. It's pretty crazy. But she did say that. That's symmetrical. I have no, honestly, that's a new term for me with the Fed, with symmetry. I hear technicians talk about that. I talk about symmetry all the time in charts. But I've never heard the Fed talk about, symmetry when it comes to inflation. So I'm going to have to do a little bit more work on that. But to me, that means that if we were below 2% for a long enough a period of time, they're willing to tolerate above 2% inflation for X amount of time. That is really rather something. And honestly, that's really what they should be doing. But the Fed to actually candidly admit that is caught me by a little bit of surprise. They're worried about then of course here comes the double talk. I think she realized what she had said. Maybe she had one too many scotches, and she goes, they're worried about being behind the curve, and risk to the outlook has diminished. Risk. Oh no, one sec. Let's get there. She talked about worried about being behind the curve, and then there was a question. She had mentioned the risks, her risk assessment. And she basically said that most people think it's balanced to down. So that to me is almost a easing bias, neutral to easing bias. Let's keep that in mind. That's really important. Would you rather have Yellen or the head of the BOJ? Is there a difference? They're both a joke. I mean, anyway. So balance. Where was I? Risk. Oh, so the risk of the outlook we talked about is either balanced to down. They say that the risk to the global outlook is diminished. I think that basically means the FXI has stabilized a little bit. China isn't puking every night, so that's really what she means. But it hasn't really recovered. Surprising. Oh, so they're still surprised that wages haven't that the wages haven't picked up. She doesn't understand that. Now, I want to break that out for a minute. If you go back to my video from last week, and I got a few people who really liked last week's edition. We really got a little bit out there. But I had a few people who said that they turned it off. They didn't like it. They thought I got way out of control, off tangent. But I'll tell you, everything is really very deliberate with me. And I knew we were going to be talking about the Fed this week, and I wanted to talk about technological advancement in that video, and I wanted to have that circulating in people's heads, because that is really what the Fed doesn't seem to understand here. That we not only have a cyclical downturn, meaning the ebbs and flows of the business cycle, but that move, that sine wave, is in the course of a major downturn, and that would be structural unemployment, technology. So think about this. Once the automobile was made, did we ever go back to horse and buggies? Buggy whips? Little OPM there for those that saw that movie, Other People's Money? The answer is no, and we have crossed the Rubicon. I'm obsessed with Caesar, right? I talked about the Ides of March in the weekend review video, and I talked about the that quote from the Shakespeare, Julius Caesar. Anyway, now we're talking about crossing the Rubicon. So I think that we have really crossed the Rubicon there in terms of technology, and there's no going back. Just like print advertising is done, it's all online now. That's the way it's going. And for those of you, someone had mentioned, I'm just going to add this in because we're talking about this. Someone asked about Amazon before and why it was down a little bit. It was because Google and Apple cut a deal for their for the web services, and Apple is now going to be using a little less Amazon and more Google, which is shocking because they have such a rivalry over Android and iOS. But I guess that's just the way it is. So that answers the Amazon question from before. But yeah, things are not going back to the way they were. I gave the anecdote that I was at a restaurant and I was able to order without even talking to someone, and this was like at a Pizzeria Uno. You got to think Applebee's and Olive Garden and all that stuff is going that way. I mean, you're not going to get that at, Jean Georges or Lutèce or Le Cirque or 21 or the River Cafe or any of those restaurants, but you will get them at where it really counts, and that's in the the chains. That's huge. The minimum wage price is going up. Health insurance coverage pricing is going up. Everything is going up, and all you'll have to do is buy an iPad or something equivalent and keep it on, and that's it. I mean, a couple $100. So that to me is rather disturbing, and that's why wages aren't going up, because there's technological innovation. I talked about, I don't want to get too wonky because I really discussed this in quite a lot of detail in the last video, but AI is coming online, and that is very real, and I do think that this is going to be very serious going forward, and I think it's going to start affecting white-collar workers, probably not in the next couple of years, but it will be coming down the road. That's going to be huge. So, and then she talked about continued slack in the labor market, and then she was starting to talk about the Phillips curve, and that's when I was starting to glaze over. The Phillips curve, for those of you interested, and I'm not going to get into it here, is the relationship between the Fed's main tools, interest rates and the unemployment. You can Google that and look that up. I really have zero interest in talking about that right now, and I assure you it's not going to help. I'm sure it's not going to help you right now with any trade ideas. Let's get into a couple of the issues that. So my take on this is. My take is this. There's a couple of more data stats here. I tweeted some of this out before, that the FOMC rate forecast is down for 2016. It's down basically a half a point for the next 2 years, and then after that a little less, and then a quarter of a point in the long run rate. I believe they had been talking about normalizing at 3.5%. Now they're talking about normalizing at 3.25%. So. That's their long run rate, which is historically low. We know they usually like to kind of ramp it up to 5 or 6. So this lower for longer theme is definitely going to ripple throughout the market. With regard to interest rate hikes, and that's really what we're kind of trying to read the tea leaves with here. If the Fed had basically said we're talking about doing 4 interest rate hikes, and the market basically called bullshit on that. And now they admitted that they're basically only going to go to do 2. So I want to talk to you about the probabilities here, if you want to take a pen and paper and write these down, because this is what it was on the Fed day, and they may change going forward, but we want to have a base of comparison. So the probability of an April hike is about 12%. The probability of a June hike had been 51% yesterday. It dropped down to 41% today, so that is very noteworthy. July is at 46%. September gets over a half now. That's to 55%. November is 58%. That's not really a live meeting in my opinion. But December is at 70%. So what had happened here now is the market has decided that a June hike is very much less likely now, and that all of the interest rate hikes are going to be backloaded into December and December. So that is that's very noteworthy. So let's keep an eye on that. I think that I'm a little torn, honestly, about June. I think it's going to really be data dependent. If I were the Fed and I were on that FOMC committee, I would really want to see 2 solid quarters under my belt, given the weakness in the global economy and the stall speed GDP we have here. We know the first quarter here was nothing to write home about. I have discussed, though, that the pace of decline has slowed. I discussed that in the last video. For those of you who are, the Fed really can't talk about gamma, but they can talk about delta. But what really just basically means the absolute change they look at or they talk about, but the rate of change. And I give this example. If you're driving toward a brick wall at 100 miles an hour versus driving at a brick wall at 50 miles an hour, you'll die instantly at 100 miles an hour, but 50 you'll probably just crack a few ribs and be in the ICU for a day or two. So that's the well, I should say more than a day or two. You'd probably be in there for a week or two, maybe longer, depending on airbag, whatever. Anyway, so that's the story with that we are kind of barreling toward the brick wall at a slower pace here. And the hope, obviously, is that we slow up or maybe even don't hit the brick wall. So I think that's really what went on there with the Fed, that people realize that they're probably not going to do much with lowering their GDP forecasts. They also had a bit of an improvement on their unemployment forecast in 2016. It's unchanged for 2017. They dropped it to 4.6%. 2018, 4.5%, and then the long run is 4.8%. Full employment is 5%. That's what they teach at business schools. The problem with that is that, like I said, in past videos, the economy has changed, and the labor participation rate is the lowest it's been in a while. So meaning people have been unemployed so long they no longer count. Let's get into some market impact on this. I know that's really what people want to hear about. And I'm going to start with the S&P 500 because that is the most important thing to cover here. That really is the stock market. So I've discussed some important levels that we've crossed through here. If you've seen my weekend review videos and you've seen me post charts, you'll know the levels that I am discussing. I'm actually going to live tweet this right now. If you're on the stream, on my Twitter stream, I'm going to tweet out S&P chart. Let's see, SPY chart. So you can look what I'm looking at, because this is going to be a little bit of technical kung fu here. So that is now live. If you want to open that up in a browser and take a look, you can see some of the key levels here. So let me walk through them with you. We had the 310 day. That's really the kind of the big doji candle, the big red doji candle. That to me was a really important day and range, as was the. So here, let me just go through them. The upper distributions go as follows. The lower end of the range was 197.86. We got into there, we held it. They tested below it on the ECB day, but we rejected back up. The 201.90 was a really, really key level. We didn't quite get there on the ECB day, but we got through there on the following day. That we also got to close that day above the 200 MA for the first time in a long time. The next 2 days were really consolidation days, and I had talked about getting a little bit concerned if we were to start closing below the body of the next day, which was really the breakout, which we had a bit of a look into and fail and went back up. So today's bar got over all three of those days, and we're well above the ECB bar. The problem is this. There is a really big gap fill at 203.87, and also the beginning of the the real upper distribution where all the consolidation was, is at 204.12. I think it's possible for the market to maybe press a little bit further into there. You could see 205s, but we have moved a lot. We came off of the quadruple bottom now of the 181, so we basically have come up from 181 but all the way back to where the breakdown happened. So we're overbought stochastically. The market is up a real lot. I honestly think the best thing that could happen here for the bulls would be some sideways consolidation. I think that would really do quite a bit of working off some of the excess here. The good news, there is some good news though. We did have this week we had some sideways consolidation the last 2 days, and the prior week before the ECB day, we had 1, 2, 3, 4,
4 days and the ECB 5 days of consolidation. So the overbought condition here isn't as extreme as it was. There definitely, I'll tell you, a lot of people, I had talked about this in a weekend review video for the last couple of weeks, a lot of people dismissed this and told me I'm nuts. We aren't that far from all-time highs. It would not surprise me if the market took another run at the highs and even eclipsed those highs, got everyone complacent, got everybody long, and then just completely lost its you-know-what. That, to me, it would be a classic type of a setup, in my view. So, someone asked, how do I think the market will trade tomorrow? All right, so here, that's a great question. For those of you who have been following me for a long time, you know that the most important day and the most important candle on a chart is the Fed day. After that, it's an ECB day, but the most important day is a Fed day. So we have a very defined range here. We have 203.82, slightly above is the gap fill. I would basically say that that gap is mostly filled here. The low of day is 201.55. I would say that if the market gets below today's low, it's a short, at least for a right or right out trade. If you start getting back through more than half of the middle of today's bar after that, I would consider it a false breakdown. Same thing with a move to the upside. Anything over today's high is going to be construed as bullish. I'd be a little bit cautious with it because we've run so much, but we could still press still higher. The SPY tomorrow, into Friday is expecting about $2.29 worth of trade. So that's roughly around where we'll be. Like I said, I really wish I could have seen the OIs, the open interest, because today's volume in SPY was huge. I will say this, though, that the strikes as of now, with a lot of open interest above us, isn't surprisingly 204 and 205. I believe 205 will be the kind of balls to the wall top for the week. I think we'll have a really hard time getting through and sustaining above that level, at least for this week. I believe the downside, there's a lot more obviously here on the call side, which to me is also disturbing, but the downside, 200 seems to be a big strike. Let me go a little bit past there. I'm curious to see if there's anything below there. That wouldn't surprise me, actually. That doesn't surprise me in the least because, like I said, it's the... Oh, boy, I put in way too many. I meant to put in 20 strikes, and I put in 200 strikes. That is a lot. It's still not enough, though. 200... That's next week. We need this week. All right, so 200 is really the big OI. Down 195 also, but I don't think that's in play, barring some kind of major event. So yeah, I think 200 is probably a decent floor. That's also kind of coincides with the expected range. It's a big round number for an expiration. So that's sort of what I think. I think the range is going to be kind of between 205 and maybe 200 till the end of the week. As long as we're above 201.90, that's a little bit more give back than I'd like to see. But as long as the market is closing over 201.90, it's hard to get very bearish. If you're an ES trader, let's discuss. I had talked about the 210 area being very important. That wound up being even more important today because that's where VWAP is, the volume weighted average price, for today. So that level, as long as the bulls could kind of hold over that level, although I'll tell you the one disturbing part about that is that the pullback low was 2012 today. That was the pullback bar after the Fed day bar. So if you start losing 2012 and 2010, I'd get a little bit more cautious. That would kind of, there's a little bit of wiggle room in here. Like the breakout was 209 quarter. 2009 quarter. So I think between 2009 quarter and 2010, that level is like the must hold here. Yes, ES. And we're talking about the M6 contract. Sorry if I wasn't clear on that. ES M6. So that to me is like the must hold here for this to really be considered real. That's sort of midway between the lows of today and the highs. I'll tell you, with regard to trading the ES on a Fed day, I don't love doing it, but I will kind of discuss about how to do it. You kind of want to do the Costanza, do the opposite. So someone had asked me today on the stream, what do I think the Fed was going to do? And I said if we came in at highs, I thought the move would be down. And if we had pulled back intraday before the rally, I thought we'd have a pop. And of course, we had the pullback. We had the shake and bake. You know, we had the rally, the shake, and then the bake back to the upside. Classic shake and bake today. By the way, if you're ever curious what I mean by shake and bake, look today at the ES chart. That was classic. So we basically we had the pullback. You had the early short covering, balanced out overnight inventory a little, although it wasn't. It was actually, believe it or not, there was a lot of net long inventory. I'm just looking at this now. I had thought it was primarily net short just because we sold off early into the open. But there was a lot of overnight inventory that was actually net long. I'd have to look at the volume there, but I think it actually was more net long. But you did have that move down early. So once you kind of got through the levels there that I had been discussing, it was obviously short covering into the rally today. I have seen where the Fed has the pop and then the next day is sort of a give back. So I'm just a little bit cautious. I want to just make sure it confirms, considering where we are in the range. Where we are is key. We're really into a lot of resistance, and there's a lot of people who want their money back. So I think that, like I said, the best scenario here for the bulls would not be to just rip it crazy high now. It would be to kind of do a little bit of sideways consolidation and kind of consolidate here over the 200 MA. The 20 MA has caught up quite considerably. That is down in the 197s. And the 50 is finally starting to flatten and to start to bend up. That is down in the 193s. So I just think the market could benefit here from a little bit of pausing and consolidating. I wouldn't really get crazy bearish on the market if we, like I said, today is the Fed day range. I think it's important. But I am mindful of the range that we're in, and I wouldn't really get crazy bearish in the market unless we really broke below 200 again. If we got below there, to me, it would be really not good. That was I talked about the hammers, where really the major support hammers, which were at 199.95, 199.96. If we start losing that area, I think the market is in for some really rough sledding. I see two likely scenarios for the end of the month. We have two likely scenarios. One is that we continue higher into the end of the month for the end of quarter window dressing, and then in the end there's a lock-in and they sell it off. Their other option is that we do have a bit of a sell-off now, where there's sort of the shakeout, and then they bake it into the end of the quarter for the window dressing. So we have a very narrow window here where we could actually have a rather sizable pullback, but I don't know that it would be kind of so sustainable short term, but medium term, we'd probably then have a bit of a rally into the end of the quarter. So that to me is really, that's really what I'm thinking with regard to S&P. So let's discuss that one more time. 204, 205 is the big OI, the open interest in the weekly, or I should say the monthly, quarterly expiration options here. And the 200s currently on the put side. I will post an update tomorrow morning once I see the new open interest and see if anything had changed there. That would be really important. And we could use the Fed day range now if you're kind of like late to the party here or you're looking to be aggressive. Anything over the 203.82, I think you can probably try a little bit longer for a right or right out. And I would say that the stop there would be anything below 202.81. If you want to try short, same thing, anything below 201.55, and I would use the same stop, which would be anything back over 202.81. That was kind of the breakout day after the ECB, the high a day. I'm just using, it's a little bit arbitrary, I realize, but that to me that's an important high. So that's what I'm using. Oil. Someone asked about oil. We know that oil is really important. I've been a proponent. We are overbought short term. I do believe that we held the 100 MA today, which is good. We're above a bit of a down, two of the downtrends, and I believe that we're looking to get close to $43. There's obviously there was a breakdown at 40 bucks, but I think we could squeeze a little higher to get a 200 MA test. So wherever the 200 MA is at the time, that's where I kind of think we're going. I like buying Exxon and Chevron on dips. That has worked for me for a while. A little something about traders. They always do what works, and again and again until it doesn't. Someone asked, I'm just going to go through this. VIX, that's really important to me. We had something happen today that we haven't had in a while. The VIX, I had drawn in an up, that like sort of like a bit of an up channel that we were in, and today we actually closed below the channel. And we made now a lower low. The last swing low was 14. No, we didn't. Not quite. 14. Today's low was 1489. We did break now below the channel. We are making lower highs and lower lows in this leg, which is important. But I'm a little concerned that we have some support coming up here between 1445. Excuse me. And 1463. I don't know if we're going to be able to run that so easily. I think there'll be a little bit of support there. I actually thought could have the potential to get down there today, and I thought that would support, but we didn't. So we need to see a confirmation. You really need to see a couple of days now close below the line. The VIX isn't like a stock. It's always going to kind of have some inherent value. I will stipulate this, though. If we do remain below the trend line, there is a possibility that we do get to see, the 1280 or maybe even the 11s here, given the fact that once a trend snaps, you usually tend to fill up the triangle to the lower part where the triangle starts. So that means there could be some lower lows coming in the VIX. That being said, it's really I think that's really hard to play for because the VIX is really oversold stochastically, and I would be looking more where we are in range here to be playing directionally. I don't really like playing the VIX directionally, but what that means when the VIX is low is that SPY options are cheap. So if you want to try shorting, if you think the VIX is near an inflection point and you see where we're getting up to in SPY with reference old supports, which should now be resistance, buying SPY puts are cheaper. Let's see. Someone asked about the dollar. I'm trying to just do the macro before we get into the micro. So the dollar today got wackarooed pretty good. It closed rather weak. It closed below the double bottom here of 195.98 half. 195.97 half. As long as we're below there, I would say that the path of the dollar is lower. We have now 3 consecutive lower highs. We didn't make a really lower low on the leg yet, which is below 95.28. Keep an eye on that. I think if we could get below 95.28, there should be a lot more downside in the dollar. I'm still not fully on board that the dollar is topped. I know everyone on TV wants to say it has. I'm still not convinced. I hate to say it. I just get that not so fresh feeling when I think about the dollar. All right. Yeah. So those are the levels to watch as far as the DX. It's been a long day. The bonds, the TLT. So the bonds are basically holding the lower end of the support range here, which is the 127s, 128s. If the Fed was going to get aggressive and they were going to really raise, you would have had the TLT really collapse. We're mid-range here. If the TLT does wind up pulling back lower, the 123s are really kind of the next stop. That's the channel low here. But we are holding the 50 MA like a champ the last 3 days, and today we closed above it. So, there might be a little bit more down, but I wouldn't be surprised to see a bit of a bond rally, particularly if the Fed is going to be pushed out for longer, if we're going to be lower for longer, so to speak. Housing. We could talk about housing. Not today, but we will talk about it. The EEM, someone asked me about the EEM. That held, we are in a bit of a large consolidation area. This was some candle today. Holy cow. We're still below the 33.42, so it's still a little bit iffy. It's starting to look better, though. I'm a little cautious on the EEM just because that has a lot of exposure to commodities, and we have had a big bounce. But I guess I could be on board for buying EEM into weakness. I would like to see how it reacts, though, to a test of about $1 higher to the 200 MA. I'm a little cautious short term just because it's run so much. I would be more inclined on buying this if this kind of came back down and then made a higher low. So that's what I'm thinking with EEM. Someone asked me about Allergan. That's been rather ominous. It's actually formed a head and shoulders, and today was now a second snap of the neckline. That to me is telling me that something is up. Maybe the deal is not going to go through we're below trend, we're below the neckline. The neckline, by the way, is 297.74. According to my math, if you want to be even a little bit more aggressive, you could say it's 277.83. So somewhere in that range. It's, to me, looking a little weak. I'll tell you, the 200 MA has been kryptonite for this. It had been support and is now resistance. You could probably short at will against that for right or right out, assuming we get back that high. I'll tell you, I've been watching, and I've talked about this a little bit. Pfizer, that has the 50 MA as its kryptonite. I'll tell you, the last 3 days in MOC for the Dow stocks that's been the number one MOC to the sell side stock, Pfizer. So I think something's up with that. I've talked about this sector for a while, particularly the IBB. My big concern there, and I don't want to keep stressing this, is I guess I have to. It's really important. There's something known as peak earnings, and I think that this industry, you have Bernie Sanders, Hillary Clinton, Donald Trump, all of kind of the likely people to be the next president are talking about negotiating drug prices. That is terrible for these companies' margins. It's great for the country, and it's great for people who are most of us who need drugs when we're sick or what have you. But it is terrible for these companies and their margins. They have very low PE multiples, but don't let that fool you. When an industry reaches peak earnings, it always is at a low PE multiple. Oddly, when industries bottom, they have very high PE multiples. That's because the earnings are about to turn at the top and they're about to turn at the bottom. There's a couple of other issues that are going on in terms of IBB, and I'm going to discuss those right now. One is the mechanics of the stock market. IBB is made up of biotech stocks, and a lot of big funds or kind of the people who want biotech for dummies buy the IBB. When it's turning down, they sell IBB. When IBB sells off, the ETF has to rebalance, and it in turn sells stocks. When those stocks go down, it in turn pulls down the IBB, which begets more selling. This selling in IBB gets more people to sell, and then it has to rebalance and sell stocks. So it becomes that vicious cycle of selling and begetting selling. I also want to point out that there are some very, very high-profile blow-ups in that space, particularly this Valiant. You have a ton of funds. You have that Bill Ackman in there. You have Paulson and Company. There's a bunch of others. These guys are loaded up in this stock at much higher levels. They are majorly underwater. Some of these companies or these firms like Ackman were down double digits last year, and they're down, I think, double digits this year. And what have they been doing to remedy the situation? They've been buying more. Oh my God! When anyone ever asks me why don't I buy companies, when they're in down, buy low, sell high, I do like buying low and I do like selling high. But I often find myself not catching the extremes because I wait for something to show me that it is low. Just because something has come down a lot doesn't mean it's low. Because it could always go lower. I like to see the pattern reverse first. A lot of people want to be knife catchers, and yes, when you get it, you're right and you make a lot of money. but you often don't. You often can lose a lot of money. I'm more for the sure money. I like to see a low, a high, a higher low, and then a higher high. I know the pattern is changing there. The same thing with shorting. I like to see a high, a low, a lower high, and then a lower low. I like to see the pattern change. That to me is the key. And, if you're just willy-nilly in there buying, you bought high, it's down a little more, let me buy a little more. And then if it's down more, let me buy a little more. That is insanity. I don't understand it. I give the example of a store that sells shirts. You have two shirts. One is selling out every day, and the other one is just sitting on the shelves. How do you get rid of so what do? Now your supplier comes in. Do you order more of the one that was sitting on the shelf, or do you buy more of the one that was selling out? The obvious answer is you buy more of the one that is selling out because that's in demand. These guys are buying more of the one that is sitting there. And how do you get rid of something that's sitting there? It goes on sale. It's discounted. That means a stock goes down. They need to lower the price to find more buyers. When something is selling out, of course, stores don't usually raise the price like that, but in the stock market, when something is selling out, the price goes higher. It's an auction. Always want to be in what's in demand, what other people are looking to pay more for. The game that we play is we buy something in the anticipation that someone else will pay still higher. When you're shorting, you're selling something when you're anticipating that people are going to panic and still sell lower. It's that simple. It's simple supply and demand. And a lot of people don't understand that. They think that, it's that the company's outlook looks good and this and that. Yes, that's all very important. I do an amalgam of three things: technicals, fundamentals, and macro. The macro, believe it or not, is often the most important. But in the short term, you have to follow the technicals. Everyone basically these days looks at the same thing. The algorithms are programmed to look at the same thing. And you will get your face ripped off if you are loading up and buying a stock on a decline. And I think that Mr. Ackman is about to really learn this the hard way. He learned this in 2001 when his Gotham partners blew up, and I think Pershing could be close. So we'll have to see how that goes. And I'm not trying to pick at him, single him out. He's just probably profiling in the news, and he's been very attached to that Valiant story. I don't, want to single him out personally, but he's not exercising good risk management discipline there, not in the least. So I think I noticed there was a bit of a drop also in Apple after hours. I think that was just because J-Bill Circuit reported, and they're in Apple. Although I noticed it's come back a bit. It had been much lower. Apple I had talked about in the weekend review that I liked it. 107s to 109s, as long as 103 is over, as long as we're over the 103s is the next range. I would be a little. You can't really sell premium in there now. It's a little too cheap. You got to wait till it gets. You'd have to see a decline in there. Someone just said. Ackman is trapped in that Valiant. I mean, a lot of these funds own percentages of the company. Huge percentages. You can't just trade in and out of that. These are millions of shares. It's a huge mistake. He isn't. I'll tell you, when he was in Gotham Partners, there was this Gotham Golf he was in, and he kept on buying courses and loaded his company up with tons of debt, and he wasn't able to finance, and he wound up having to close his fund. So it's a little, reminiscent. Sometimes history has a way of repeating. I think he still has multiple billions of dollars under management. I don't know how much longer those billions are going to stay there. People who put their money in hedge funds are a little, they pull their money kind of quickly. I don't know what his covenants are like, but it's troubling. Valiant has a lot of problems. They have a lot of debt, and their equity is worth less than their debt now. That's not good. That means that the company is probably in a lot of trouble. I think we covered a lot here. I wanted to cover more, but I think for now we're going to call it a day. So let's call it quits there. If you want to rewatch this video, you can see it on my YouTube channel, which is Justin Pulitzer Trades. If you aren't following me on Twitter, you should follow me. My handle is @JustinPulitzer, and I will cover more of some of the stuff you guys had listed, like the Netflixes, go into a little bit more detail on Amazon. a little bit more detail on some of these other momentum stocks in the weekend review video. Anyhow, let's have a good rest of the week, and cheers. I will post, by the way, that open interest a little bit more on the in the morning once I see what that OI looks like for SPY. All right, guys, cheers. Thanks for watching.